Good afternoon, everybody. Welcome to this NISA webinar. Crisis, what crisis? Bond markets, the public finances, and UK economic policy options. The genesis of this was the quite remarkable increase in bond yields that we saw at the beginning of January. Of course, since then, bond yields have come back a little bit, but we still thought it would be worth gathering some experts in this area together so we could get their views on what caused the rise and subsequent fall in bond markets, whether we should worry about it, and more importantly, what the implications are going to be for the UK government and the UK Chancellor in particular. We have a very distinguished panel, as I said. Okay, we have a very distinguished panel, as I said. Once we managed to sort out once we managed to sort out a few technical glitches, we will hear from Professor Jagjit Chadha, who is the Distinguished Professor of Economics in the Faculty of Economics at Cambridge. Until December, he was the director of the National Institute. Had been there for 8 years, since 2016. He's also recently served on the Royal Economic Society Council from 2019 to 24. From 2011 to 17, he was the chair of the Money Macro Finance Society. He's also, in his long and distinguished career, been a professor of economics at the University of Kent, the University of St Andrews, and also a fellow at Clare College, Cambridge, and indeed has also worked at the Bank of England. We also have Sushil Wadhwani. Sushil is the founder or was the founder and chief investment officer of PGIM Wadhwani Asset Management, although he stepped back from this role in 2023. Ahead of that, he had a long and distinguished career in the city, and also served on the Bank of England's Monetary Policy Committee between 1999 and 2002. We will then have Bill Allen, who's a visitor at the National Institute for Economic and Social Research. He worked at the Bank of England from 1972 to 2004. That's, I think, even longer than I worked at the bank. He served there in a number of capacities, including most recently the Deputy Director for Financial Stability and the Director for Europe. Since 2004, he's worked in the private sector and now writes independently and has written extensively on monetary subjects, including 3 books: International Liquidity and the Financial Crisis, Monetary Policy and Financial Repression in Britain 1951 to 59, and the Bank of England and the Government Debt Operations in the Gilt-Edge Market 1928 to 1972. And then we will have Paul Mortimer-Lee. Paul, again, is a visitor at the National Institute. His career with official institutions and investment banks has included roles at the Bank of England, the International Monetary Fund, and latterly as chief market economist and head of US economics at BNP Paribas in New York. He's frequently appeared within both print and broadcast media, as well as being published by the House of Commons. Now, those 4 that I've announced will talk about some work that we've put out on our website, and I hope that all attendees have received copies of the papers. Once they have all spoken, we will have Helen Thomas discussing what we've heard. Helen founded Blonde Money in 2017 to explore the unpriced risk in financial markets and to bring together the worlds of Westminster and Wall Street. Prior to that, she has 20 years' experience in financial markets on both the buy side and the sell side, with a global macro focus. She actually worked for George Osborne and founded the Financial Markets Research Program at Policy Exchange. She's also a board member of CFA UK. Okay, so that's enough of the introductions. And just in case you don't know me, my name is Stephen Millard. I'm currently the acting director here at the National Institute for Economic and Social Research. Great, lots of introductions. time to hand over to Professor Jagjit Chatha. Well, I'm hoping someone is going to unmute.
Good afternoon. Good afternoon, everyone. Stephen, can I check you can hear me?
We can indeed, Jagjit. Go ahead.
Thank you. Thank you very much. Sorry, it's all a bit odd. Well, thank you for organising this, Stephen. It's a very important event and a very important moment for us to discuss this. May I start with two brief apologies? Firstly, I can't be there in person as I'm on my first holiday for over a year, going twitching. If you don't know what that is, look it up afterwards. I'm en route. And that leads to the second problem, is that I'm using my phone in a rather remote area. So I'm doing my best. Please bear with me. It also probably means I ought to hang off after my talk, but I am available to answer any questions subsequently. And I know Stephen will be keen to hold my feet to the fire, as he always does. Again, I'd like to thank the National Institute for organising this short notice. This is an in our spot. We're critical friends of all sides, and hopefully nudge the public debate and ideas into the right space, because I think they've gone array in the last year or so. I'd also like to thank Central Banking and Dan Hinge for encouraging me to write up my thoughts over the last few weeks. He's a good chap to chat to, if I may say so. Actually, I feel a bit honoured to be in this company this morning. I counted up the market experience of me and the fellow panelists, and it's well over 120 years. Now, it's not bragging or showing off, but it will say to those of you who are trying to follow the money and understand what's going on, it might be better to give a bit of time to those who've got experience and worked in this field for a long time, rather than, for example, and don't want to denigrate anyone who's just come into this area from university. We were all young once, but the knowledge and experience we bring to bear after a couple of years is not the same as we have some 30-odd years later. That's something you might want to bear in mind when you consider the various impeti on the debate. Now, let me cut to the chase. The bond market histrionics of the last few months have, to be honest, irritated me. You get a sense of that from my central banking article, if you have a chance to read it. And the change has been very odd. And I want to sort of go through my view briefly. I'm sure no one wants to hear me speak for very long. We have an excellent lineup following me, who I'm sure you'd like to hear more from. And the main charges I can see against the Chancellor is that she is responsible for the high funding costs in some way. And these high funding costs have made the fiscal position untenable and unstable. And I want to try and convince you in the next few minutes, or at least start to put some doubt in your mind if you accepted that view. So the first top line is that, am I still on? Have I done something wrong there? Can everyone, Stephen, can you still catch me?
Yeah, you're still on, and we're still we're
right.
wrapped in attention.
You're very kind. So the first point is the Chancellor is responsible for high funding costs. Well, really? As I'll say a little bit later on, the main determinant of funding costs are bank rate. Now, I'm told the Chancellor used to work at the Bank of England as an economist, but I don't think, unless I've missed it, she was on the MPC setting bank rate. And bank rate has gone up in order to try and deal with a huge inflationary surge. The benefit of this, the bank rate has gone back to historic norms, and as a result, funding costs have gone back to historic norms. As far as I can see, this has very little to do with policy as practiced by the incoming government, and mostly nearly everything to do with the MPC and its mandate to control inflation. Had inflation stayed negative, we wouldn't have the funding costs that we've got, and so we'd have to find some other excuse. Second charge is that the fiscal position is dangerous and untenable, and that's also wrong. Let me make two precursor points. I value price stability and fiscal stability as primus inter pares, the first duties of government. So nothing I say today should be taken as a view that price stability doesn't matter and that we can borrow at will. What I'm really going to talk about are the processes of choice and the implications, whether we have the right structures in place and how we move towards better policy choice that I think nearly everyone would agree is what we need. I'm not entirely sure that anyone would take the results of economic policy that we've had to swallow in the last few years. So we need change, but we don't need change in an arbitrary manner. We need structured change. So I'm convince you that those charges are wrong, if not rubbish. Another point. The debt service has increased. Actually, if you look at the average debt service, that's interest payments on public debt as a fraction of revenues, it's about the post-war average. Now, that doesn't mean it's not a concern. Debt is high, interest rates were low, so interest payments were relatively low. And if interest rates remain high, they will climb above the post-war averages. But averages are averages. At the moment, they don't look greatly out of whack. That doesn't mean I'm not concerned. If my team only gets an average of half a point a match, that's the average, and I could stick to the average, but I still might be concerned. But it doesn't mean that it's performing in a way that surprises me. It's my fault for supporting that team. Now, what determines borrowing costs? I've already hinted at the answer. Huge literature. And we have a joke at the Institute that when anyone starts talk about something they don't know about, they say, there's huge literature before going on to say nothing at all. But that literature says that borrowing costs, long-term interest rates, are about 90% determined by bank rate or the level of interest rates and its expected path. So that means where interest rates are now and where they're expected to go in order to bring inflation back to some target. And time again, study after study, for a generation or more, we get that number. So we can't really then charge the Chancellor with the level of interest rates when it's actually determined by another august organization. Now, the other factor that drives long-term interest rates is, of course, risk premium. So we might have a world in which bond market participants want to be paid a little bit more because they think the bonds are risky. Or they don't want them at the moment. There's oversupply. So they're saying, well, if you want me to hold these, pay me a bit more. Just like buying a car, really. So in comparison, as we're comparing so much of what's gone on in the last few months to the Truss Kwarteng special fiscal operation, what does the risk premium look like? Well, as far as I can see, the risk premium today on UK bonds is again about average. What happened in autumn 22 was a huge spike in the risk premium. So why did we get a spike then and we don't get one now? Well, overnight, without any sort of refereeing or agreement, the Truss Kwarteng special fiscal operation tried to add at least 3% or more to demand immediately and with the promise of more to come. Now, you can do a rough calculation, and that implies a huge increase in bank rate overnight. So if you're suddenly told on day one, this is the level of demand, and then you're told on day two, there'll be uncoordinated, a huge increase in demand, interest rates will be expected to rise and bond prices will fall. And that's what happened. any superficial similarity is a figment of a deranged imagination. They're entirely different events. Second is an elected government steering through difficult waters, yes, but not making huge, worrying announcements. What happened in autumn 22, I think, scarred us all. We all learned a lot from it. And hence the risk premium tripled or more at that time. There were some horrible words used about the premium. I won't repeat them here. So there's a difference, number one, that anyone would know about and shouldn't really be saying they're the same shot by a number of people. And people who I thought ought to know better. I'm not trying to be condescending. It just sort of surprised me. So let me move on because I'm running out of time. So
if you can be very, very quick, Jagjit, I would appreciate it.
Yeah, well, okay. 2 minutes. So my maxim is if we want to change policy, we need to identify the shock. And I can't identify any shock that's led to a big surprise in the change in bond yields. The risk premium is normal. My contention is nothing much has changed. The deeper problem really is the fiscal rule. Now, if I was being facetious, which I often am, I might say what's going on here is the bond market participants thought that bank rate was going to fall and quickly. So they told their clients and bosses that bond prices would go up. The bank faced a stickier inflation target, didn't lower bank rate, bond prices didn't go up, and they lost a lot of money. So who are they going to blame, themselves, or they'll say the chancellor's got it wrong? And that's one way to think about it. But the deeper point here is that a bargain between agents, fiscal policy, debt markets, that is not proportional or strictly related to the social welfare function is not tenable, cannot be stable. And what we have is a world in which the government thinks it has to stick to a rule, just as we had under the gold standard, 1931, Bretton Woods under the 70s, and ERM under 92. We were told there's no alternative, we have to stick to this rule. But when we finally fell out, the economy performed very well and better than our competitors. And that's just we find a way of doing that, and soon, if we want to reach our growth targets. We should choose policy that's proportional to the social welfare function, quickly explain it, get the markets behind us, and we won't get these levels of disagreement and miscoordination, volatility, and ultimately things that might damage the real economy. With respect, Stephen, I'll stop there. Thank you very much for listening, everybody.
Thanks ever so much, Jagjit, and I'll make sure that any questions are forwarded on to you, so to give you the opportunity to answer them. Thanks again.
Thank you all very much for your patience. Thank you all very much for your patience. Hope to see you soon. Goodbye.
Thank you. I'm now going to hand over to Sushil Wabwani. Sushil.
Great. Well, good afternoon. Thank you very much, Stephen, for giving me the opportunity. I've had a very long association with the Institute, and it's sort of great to be with all of you today. And thanks to Jagjit, even though he's not here now. Now, if one looks at the rise in gilt yields, certainly there are some puzzling aspects, but I thought that I would attempt to try and tease out what caused what over this period. Now, what I would say is that in a very old-fashioned way, I like doing event studies. I used to be, as an academic, a financial economist at the LSE. And if you do sort of an event study type, if you adopt an event study type approach, then there's very little doubt that UK fiscal events played some role in driving up yields before the US election. So if, for example, you look at the market reaction between the 29th of October and the day after the budget, you see a meaningful rise in UK yields relative to global yields. So there was a bit of a surprise on budget day. The market reacted. there were actually surprises before budget day because in their inimitable fashion, the Treasury leaked stuff. And if, for example, you extend this event study and go back to September, you can essentially associate each leak with gilts doing worse than global markets. So I'm going to take it as a given that a part of the rise in gilt yields did happen because of UK fiscal news. However, in the paper that was circulated, which I did for Vox EU, I've deliberately focused on the period since the 5th of November, because that was the US election. And I wanted to deal with something, I read 7 times a day, which is UK yields went up just because US yields went up. And that statement always puzzles me because if one looks internationally, then 20-year yields in many countries, for example, Germany, Portugal, Spain, Japan, and so on, went up much less since the US election as compared to the UK. So one really does need to dig deeper and try and understand why the UK has essentially kept up with the US while several other countries haven't. So in order to do that, one thing that I did is try to understand why US yields went up. Now, US yields didn't go up because the Fed funds rate went up. Of course, the Fed funds rate has fallen over this period. But it is true that shorter term expectations in the US did go up somewhat. So 2-year yields went up, essentially because the markets came to expect less easing by the Fed. But that didn't happen here in the UK. So if you compare what happened to 2-year yields in the UK versus the US, you find that doesn't really play much of a story here. So that doesn't explain why gilt yields essentially kept up with Treasury yields at the long end. A second possible explanation for what went on in the US is that Mr. Trump unsettled longer-term inflationary expectations because of a variety of policies he's been talking about. Well, that's probably played a modest role in the US. I make it 11 or 12 basis points over this period, but it hasn't played a role at all in the UK. Our longer-term inflationary expectations have hardly moved. A third reason, highly plausible reason US yields moved up is because of a change in foreign official demand for US Treasuries. There's a variety of countries perceive greater hostility from the president, and they sold US Treasuries and bought gold instead. That certainly, I think, is an important factor in why US yields went up, but it can't explain gilt yields because we haven't seen those comparable flows in gilts. Has it been fiscal sustainability considerations in the US? Certainly in an R minus G framework, you should be very worried about the US, especially as they seem to be planning on running a primary deficit as far as the eye can see, while R is considerably above G. But actually, the US dollar has been going up. So at first blush, it doesn't look like that fiscal sustainability worries have as yet played a role in the US. So, where that left me was to essentially fall back on the notion that contagion played some role. And by contagion, I mean the sort of mechanism through which each market looks at other markets, watches the price movements, and tries to infer information from those price movements per se. And in the very short run, markets follow a shoot first, ask questions later type approach. And because of that, you do get that move in sympathy in the short run. It's what many, many years ago, Mervyn King and I wrote a paper about this straight after the US stock market crash. And we showed how this was a plausible explanation for why global stock markets fell in unison, even though the news flow was very different across countries. However, if you place weight on contagion, I think over this period, it can only explain about 1/2 of what's happened in the UK. So you then have to fall back onto UK-specific factors having played a role. Now, it's unlikely to have been the budget, because the period I'm looking at is 4 working days after the budget. So the budget, you've got to assume, was already built in. But it could be fiscal sustainability concerns. I think one needs to tease that out. And the reason I'm cautious is that for much of the period, the exchange rate didn't weaken, but certainly in January, sterling did weaken across the board. So there is a hint there that the markets were beginning to worry about fiscal sustainability. I'd say the second hint is what I referred to earlier, which is the fiscal paragons, the Germanys of the world. Yields have gone up much less than they have in countries which have more fiscal difficulties, the UK, France, the US, and so on. So there's certainly a hint there that the markets are now beginning to differentiate. Now, having said all that, we have to remind ourselves that for many, many years, bond vigilantes have been slumbering. And they were slumbering because R was typically quite a bit below G. Of course, in some of our countries, not all of them. So, for example, not true in Germany, but certainly in the US and the UK, R is now comfortably above G. Yet in the UK, we're running a primary deficit of 1.6%. And if you believe the OBR projections, you'd be okay, but there are many reasons not to believe them in terms of us achieving a primary surplus in coming years. And therefore, I know I'm running out of time, so I'm going to just take 1 minute, if that's okay, and say that I do think with the government having stated that the fiscal rules are non-negotiable, that makes it doubly important that they do tighten fiscal policy in the coming period. When you get into a situation where bond vigilantes are active, and I think they're beginning to get active, one can't predict quite when they'll attack. I mean, that's one thing we know. We know the limits of our knowledge in terms of the precise timing. But it's very important, I think, that the UK, in terms of the perceptions of market participants, puts itself with the good people rather than the bad people. And I believe that in order to do that, we will need some fiscal rectitude. And I also, in the paper, suggest that because the UK has this unusually high inflation risk premium embedded in gilts, that we should be issuing more index-linked gilts, and we should seriously consider allowing the BOE to set its own inflation target and therefore come more in line with the ECB and the Fed. And I'll stop there. Thank you, Stephen, for being patient.
Thanks ever so much, Sushil. I should have said up front to all participants, if you have questions, if you could put them into the chat, hopefully there will be a bit of time after everyone's spoken to answer them. But if not, we'll try and make sure that they get answered anyway within the chat. Okay, I'm going to turn now to Bill Allen, who's going to tell us a little bit about where QE and QT fit into all of this.
Thank you very much. It's a great pleasure to take part, and I'd like to thank Stephen very much for inviting me. I'm going to talk about the budgetary losses incurred by the quantitative easing programme pursued by the Bank of England in successive waves between 2009 and 2021. They brought in all £875 billion worth of gilts valued at the purchase prices. The accounting has been commendably transparent. The gilts are held in a subsidiary of the Bank of England called the Asset Purchase Facility, or APF for short, which publishes its accounts every year. The purchases have been financed by a loan from the Bank of England proper to the APF, which bears interest at bank rate. In other words, it's a floating rate. And in turn, the Bank of England finances the loan to the APF by borrowing from the commercial banks through increases in their reserve balances, which also bear interest at bank rate. So the APF has a very large exposure to interest rate risk because it holds fixed rate assets matched by floating rate liabilities. And although it's a subsidiary of the Bank of England, it's indemnified against losses by the Treasury, and the Treasury likewise gets the benefit of any profits. Now, could we have the first slide, please? This shows you why the losses have arisen. They arose because the bank bought gilts at steadily declining yields over the 12 years. But since the program ended in 2021, short-term interest rates and gilt yields have risen very sharply, hence the mark-to-market losses. Now, they began unwinding the program in 2022, and some of the losses have been crystallized as the gilts in the portfolio have matured or been sold. The final extent of the loss won't be known until the unwinding is complete and the APF has been wound up. To a very large extent, it will depend on future short-term interest rates and gilt yields. At the end of February 2024, in other words, nearly a year ago, the mark-to-market loss was 104 billion, as derived from the annual reports of the APF. And on my calculations, at the end of December last year, it was 128 billion. In other words, about 4.5% of GDP. Since the cumulative payments so far have been on balance from the bank to the Treasury, the future payment due to the Treasury from the bank are somewhat larger than the lifetime losses of the QE program. That's on the next slide. The impact of all this on the budget balance is determined by the agreement reached in 2012 between the Chancellor, George Osborne, and the Bank of England Governor, Mervyn King. They agreed that the Bank of England will pay to or receive from the Treasury each quarter the difference between the APF's gilt interest income and its interest and other costs. So the quarterly payments depend on the difference between the average interest yield of the gilts held in the APF and the bank rate, which is the rate charged on the APF's borrowing. So while short-term interest rates were ultra low, the Bank of England made quarterly payments to the Treasury, which reached a peak of 124 billion in July 2022. Since then, short-term interest rates have been higher, and the direction of the payments has been reversed, so that during 2023-24, the Treasury paid the bank 44.5 billion, and according to the OBR forecasts, the payment will be 35.4 billion this financial year and 16.8 billion in 2025-26. These forecasts are obviously very sensitive to the assumptions about interest rates and gilt yields. Now, the difference between the interest yield on gilts and bank rate isn't the only source of loss to the public sector. Nearly all of the gilts in the APF were bought at prices above 100, but they will all be redeemed at 100, so that there'll be a loss of value. Now, losses from this source won't affect the budget balance, but they do affect the total of the government debt. So, for example, if the APF spent 1.5 billion on gilts priced at 150, it will have bought 1.5 billion to finance the purchases, ultimately a liability of the Treasury. When the gilts mature, the Treasury's liabilities will fall by only 1 billion. So the total government debt will be 500 million higher on balance as a result of the operation. Now, I've spoken only of the budgetary costs of the QE program. If we could have the next slide, please. They're large and serious because they imply higher future taxation and probably as a result, lower future economic growth. If we were going to do a comprehensive assessment of quantitative easing and its suitability for future use, you would need to recognize, obviously, that its objective was macroeconomic stabilization. It wasn't designed to make a profit. And you might actually conclude that the welfare benefits of stabilization exceeded the welfare burden of the budgetary costs. But even in that case, you would need to consider whether any other policy which carried less risk to the public finances could have achieved similar stabilization benefits. And I'll stop there. Thank you.
Thanks ever so much, Bill. Finally, in terms of papers, I guess, that we've put out on our website, Paul Mortimer-Lee. Paul, over to you.
Thank you, Stephen, and thank you to the other panelists. I learned a lot from what they've said. So I want to look at three things. One is why the reaction to the October budget was different from 22. What one of the underlying factors is, which is sustainability, and finally just say something about the budget and how I think that that hasn't done anything to improve sustainability. So what this little chart looks at is some econometric estimates of bubble-like behavior, so mildly explosive behavior in the gilt market. And what you can see is that since 2020, we've seen more episodes that look significant. So there was the dash for cash, for example. But there was also stress before the budget in 22. And why was that? And there were already signs of a collateral shortage in the repo market. So what you saw was that we had repo rates substantially below bank rate, which tells you something about the shortage of collateral. And it also tells you about the segmentation in the repo market, because you didn't see that in other markets to anything like the same extent. So the repo market wasn't working very well. So the Truss Kwarteng budget was a bit like lighting a fire in California. It wasn't a good idea. You know, what they did was provide a very big shock. And given that the repo market was not functioning well, there was a shortage of collateral, that gave us a huge spike in yields as LDIs offloaded gilts and financing, with 30% of the financing come from non-bank financial institutions, dried up. What's different about the budget in the current episode, you can see it hasn't shown the same amount of stress, is that you've got 250 billion fewer reserves, and the free flow of gilts in the market is up by 500 billion, partly because the bank sold some of its holdings, and partly because there's been a big budget deficit. So the balance in the repo market is very different. There's not a shortage of collateral. And so the same sort of dynamics, coupled with the fact that we now know there's a Bank of England backstop, didn't give us the same blowout in yields. However, you know, what I would say is the fact that the Bank of England, for the first time in 331 years, is going to lend to non-bank counterparties, tells you it's very fearful of non-bank financial intermediary-led stress in the market. We're pretty vulnerable, and I think all the central banks and BIS know that. So let's move on to the budget dynamics. We saw Sarah Breeden in the Financial Stability Report in November say one of the things that was threatening financial stability is budget sustainability. And she wasn't just talking about the UK, she was talking about the US and indeed all other Western countries. And that is a vulnerability when you've got things like a trade war going on, which seems to me is likely to get worse rather than better, which will hit activity, will require budgetary support for some sectors that will get hit. The concentration of losses due to protectionism will be very concentrated, won't be spread throughout the economy, and that's a risk. And what's behind the dynamics of sustainability? And it's largely total government spending, which the OBR shows is going to get to 60% of GDP in 50 years' time. Now, okay, that's a long way away, but nonetheless, we're vulnerable. We've got very high debt ratios already. We're vulnerable to adverse shocks, and we can see the problem of the real interest rate exceeding the real growth rate. Now, in terms of the UK, are we really going to increase taxes or revenues to 60% of GDP? No. Are we really going to tackle the spending problem? No. Now, you can think what you like about Musk taking over the Treasury computer system and what that's likely to mean. But what it probably almost certainly means is that their problem is the same as ours, which is the inexorable rise in total government spending. They look like they're going to tackle it probably in a way that's going to cause a recession, but they're going to tackle it. We're not. If we look at the next slide, it tells us about the over-optimism of the OBR's projections. So as Krugman said, productivity isn't everything, but in the long run, it's almost everything. And that's true for the debt GDP ratio. Now, the OBR's baseline has productivity of 1.5% a year, a bit more going out in the future. We've not seen that since the 1990s. So where does that come from? And if we take a more reasonable assumption, which is productivity continues to do what it's been doing, about 0.5% a year, you can see that the debt GDP ratio is absolutely on an unsustainable path. Absolutely. And maybe this relates to Social's point that the risk premium, the inflation risk premium in the UK is unusually high. How did we get our debt GDP ratio down from 200% after World War II? And the answer is through inflation. So the risk is that we're going to deal with, we don't seem to be able to tackle spending. We don't seem to want to raise revenues as a share of GDP. So we're going to do it through inflation. So if we move on to the next slide, please. Just looks at the budget. So one of the ways to increase productivity growth is through increasing investment. What the OBR shows is we've got higher public sector investment, well, higher than Sunak programmed. And clearly, budget projections before the current government were wholly unrealistic. There was a black hole. But if we look at the pre-measures forecast for private sector investment, it's actually higher than post the budget measures. The budget just rearranged the deck chairs on the Titanic. It didn't actually increase investment very much as a share of GDP at all. It did in relation to the previous plans, but in terms of did it make a difference to GDP, where GDP would be in 5 years? The answer is no. No, it didn't. So if we move on to the next slide. So the little thing at the top is just a rearrangement of the Kalecki profit equation, which is itself a rearrangement of the national accounts identity. So investment basically equals retained profits plus the household saving plus government saving plus whatever saving foreigners are prepared to give to us. And it's an identity. It's not a behavioral equation. It's an identity. The government objective of government saving of 0 comes from 0 is a nice number, but that's not what you should do. If you want to raise investment in the economy as a whole, you have to set government saving in relation to what the other sectors are saving. And if the other sectors are not saving very much, the government has to have a surplus. And if we look at the chart below, you can see that the golden age of investment in the public sector came when the public sector had a high current surplus going forward. I mean, it makes sense, right? Investment has to equal saving. And so if the government saves more, it can invest more, and it aims to save nothing. So therefore, it's not surprising it's not going to invest very much. The other thing to say about this is that in terms of the budget, what did you do? What did we do? Well, we gave more to the poor. We raised the minimum wage. We gave more to public servants. We took away cash from well-to-do households. So we reduced household saving by one of those measures, and we transferred from retained profits to households' cash flow. And we gave it to households who don't save very much. And so, of course, we're going to reduce private sector saving in those circumstances. So the budget, in terms of what it set out to do and what it actually achieved in terms of cash flows, were completely at odds. Okay, just to wind up, and I'm wound up. So gilts are increasingly unstable. It's probably, and that's due to the repo market, the collateral position has changed that. Long-run fiscal prospects are the underlying dire position. The budget projections are just not realistic. Productivity growth is lousy, and the budget does nothing to improve that. And on that optimistic note, I'll finish.
I couldn't hear Stephen, but I'm jumping in. You can hear me. Okay. So, right, let's just quickly see if we can find any consensus there within those thoughts. This is what I've broadly picked up to canter through it. This episode since the tail end of last year is definitely not like 2022. That much seems to be a broad consensus, whether you're as irritated as Jagjit about that or just mildly perturbed. But it is still bad. You heard from Sushil about some quantitative measures on that, about the impact that there has been on the UK. It's not purely a US issue. You heard similarly from Paul about that too. And we heard as well from pretty much everybody that it's all about R and G, and that when you've got a debt sustainability problem, then how are you going to solve when R is bigger than G? And that is kind of underlying this instability you just heard about from Paul. So that's sort of the broad consensus. I know we're running short on time. I'm going to talk about the political constraint to all of this because we've talked about the economic one. But I just want to grab a few quotes from what we've just heard there. So Paul, in his piece, I'm going to quote you back, Paul, you said, the unsustainable debt profile makes the gilt market vulnerable to adverse shocks. And this is the key, really. It's in whether or some other shock that throws gilt yields higher, the actual foundations of what we're dealing with, and this goes back beyond the new administration to the prior government, has left things very vulnerable. And then Jagjit mentioned in his note about how the risk premium shot up under trust because there was no coordinated agreement between the Treasury, the OBR and the market about the quantity of debt the government was seeking to sell. Now, that's an interesting turn of phrase about no coordinated agreement, because it seems to be that what happened on budget day that's exacerbated some vulnerability is that, frankly, the borrowing numbers were bigger than expected. And finally, from Sushil, I want to grab it's just two simple words which matter, it's very important to listen to, which is narratives matter. So all of this can be dealt with if there's a coherent and consistent story to deal with G. And my point that I would like to make on this is that you cannot solve R greater than G without splitting the Labour Party. And that is the political constraint to all of this, because you can already see that, well, the tax burden is the highest it's been in many decades. There's a point we all know as economists where you can't raise tax any further anyway, you just won't get any more money in. And then when it comes to spending cuts, well, look, that would be anathema to a Labour Party that has grown up on disgust at what it saw as the Conservative Party's dreadful austerity of 14 years ago. And by the way, I make no comment on whether this is all right or wrong or whatever you might think personally. It's simply the inevitable logic of the position. So when the bond vigilantes come back, and they will be, because they do smell blood in the water, not just here, of course, but across the pond and across all Western worlds that have incurred huge debt since the pandemic. And by the way, you know, Sushil, you were talking about, we don't know when, but, you know, there are these staging posts, you know, the next PSNBR release, if that again shows that borrowing is higher than we thought, we've got the 26th of March OBR update. There will be points along the way for this. Fine, perhaps it ends up with a defenestration of Rachel Reeves, but even then, you know, would a Wes Streeting or Yvette Cooper or Angela Rayner do something different? And you can already see the fraying that there's happening even over things like the runway at Heathrow, because this is the point I want to leave you with. The Labour Party have a large majority, but they don't have a mandate. They said what they weren't going to do. They didn't say what they would do. And that is going to, unfortunately, cause them a lot of problems. It caused the prior administration problems too. It's on, to be honest, with the public, something Paul's picked up on in his piece. And so I throw that into you, that, you know, we've talked a lot about the economics, but there's a potential convexity issue based on the political side of this as well. I'll leave it there. And Stephen, I can't hear you.
I can't hear you either.
Can you hear me now, Bill?
Yes, I can now.
Right.
Yeah.
Okay. So hopefully the audience can hear me now. Much food for thought from all of our panelists there. We have a little bit of time for questions. So far, I see we have a few questions. I've got one from an anonymous attendee asking, to what extent is Bretton Woods, or the end of Bretton Woods rather, the root of all evil? That's a nice one, but I'm not sure that can be answered particularly quickly. I'm going to run with a couple of questions for Bill, which should be able to be answered relatively quickly. So I've got one here from Joseph asking, was QE in the UK significantly different to the US and other countries? And is the assessment of stability versus profit similar? Bill.
Yes, it was significantly different from the US and other countries in quantity terms for two reasons. Firstly, the Bank of England bought longer maturity bonds than the United States with the Fed or with the ECB or the other countries. And those are more sensitive to interest rate fluctuations, and the financial risk was correspondingly bigger. Secondly, whereas the Bank of England bought nearly all government securities and only a very tiny amount of other securities, the other central banks bought a much larger percentage of non-government securities, which typically had less interest rate risk. So it was the same kind of qualitative problem, but we did much more risky things by buying longer maturity bonds.
Great. Thanks, Bill. One more for you. Do you think that the QE done during the pandemic was a mistake, given the fiscal costs now? While it stabilized markets in the early part of the pandemic, 450 billion now seems a little excessive. This is from Tom Rees.
Yes, I do. They had to do something because the gilt market had become dysfunctional in March 2020, just like it did during the Truss-Kwarteng episode. They certainly had to do enough to stabilize it, but that wouldn't have been anything like 450. I mean, it would have been double figures and probably less than 50. I think the rest was a mistake.
Thank you. I personally would very much agree with that. I can see Paul nodding as well. So I think that's true. I'm going to skip the Bretton Woods question, but there's a really good one here from an anonymous attendee. It's the classic wrap-up thing, which is, What single measure would members of the panel take to, quote, solve, unquote, this issue? So I'm going to go around all the panel, and you can use that question as a kind of a way of summing up, if you like. And I'm going to start, well, I'm going to go backwards. I'm going to start with Helen.
Have a general election, get a mandate.
Great answer. Paul.
Yeah, have a credible path to get the budget sustainable longer term.
Yeah, thank you. Bill.
Not have a general election. I think they've got a mandate already. And I think that they need to do a lot as regards fiscal consolidation, which has got to mean doing things to stimulate growth and at the same time making the public sector more efficient.
Thanks, Bill. It's always good when panelists disagree with each other. I always think that kind of helps make the session a little bit more interesting. Sushil.
So I completely agree with Helen that it's going to be really politically tricky. But having said that, I think we have no choice, because otherwise we'll get a full-blown crisis at some point. And for those reasons, what I would do is I would do growth-friendly tax reform. I would do courageous things on growth, like getting much closer to Europe. You clearly want to make government spending more efficient. And then I would also look very actively at how we can reduce debt interest. So examples of there would be what I alluded to before: increase the proportion of issuance that's index linked, hand over the inflation target setting to the bank rather than leave it with the Treasury, and so on.
Thank you very much, Sushil. We have actually another question has appeared. We have time. This one's for Paul. In looking at government spending projections, have you seen a marked increase following the recent record years of debt issuance in the UK? And do you think there's a tipping point where we become unable to reduce spending just to keep up with redeeming debt?
Yeah, sorry. Yeah, is there a tipping point? I think we're already... No, I don't think we can reduce spending. I think it's extraordinarily difficult, partly for political reasons. The current government won't do it. The other, another government got in. They've become immediately massively unpopular. I don't think there's a prospect of tackling the fiscal problem until it becomes explosive. You know, the markets, there's some concern there in the markets, both here and in the US, and that, you know, it shows in the forward term premium in the US, which is widening, is wider than it is currently. So the market's aware of it. But generally, you know, the debt won't matter until it matters, and then it will be all that matters. And you know, we don't know where that point is, but it seems when we get episodes like 22 that, you know, we're sailing close to the wind. We're sailing close to the wind, and if we get very big adverse shocks, we will tip over.
Yeah. Again, I'm just praying that somebody has something, what's the word, a little bit more upbeat to say.
One thing I would say is that everybody's very pessimistic about economic growth on the grounds that it hasn't been very strong for a long time. But the truth is that nobody really understands what the mainsprings of economic growth are. Nobody really understands why it's slowed down a lot, and it wouldn't be all that surprising if it speeded up again. And indeed, if you look at the performance of equity markets over the last few years, that actually is a bit of evidence that maybe it will speed up again. So although I can see that there are grounds for being worried, I don't think there is any need to feel that we've got a kind of inevitable doom looming ahead of us and we can't do anything about it.
I don't disagree with Bill in the sense I've spent the last year looking for some glimmers that AI was going to start pushing up productivity growth. The only place I can see that is the US. There's really remarkably little evidence that it's pushing up productivity growth in the UK.
So maybe we just have to hope for spillovers to come our way.
I mean, it depends on what it does to the distribution of incomes, right? So, I mean, one of the reasons equity markets have done well is particularly under Biden. We've seen a fantastic increase in the profit share at the expense of labor. And so, yeah, of course, if the profit share keeps going up, then equity markets will continue to be strong. And maybe AI is one of the things that will keep the profit share up, because it will substitute, you know, the value added by capital will go up, and the value added and the share of income going to labor will go down. And that's a reason for optimism, but it doesn't mean you're going to get growth, because you're going to be taking away income from the ordinary people who spend 95% of their income. And you're going to be giving it to Musk, who definitely does not spend 95% of his income, and the other, you know, tech bros.
Fantastic. Okay, we are out of time, but I am going to give Helen an opportunity for a last word, and then I'll have a post last word, if you like.
Well,
But
I was
Helen,
just thinking about your point about being optimistic, and here's the thing. I always talk about business is about what works and politics is about what sells. And eventually we will get a politician with the mandate that will sell. The other thing I tend to say is that, you know, Superman wins elections and Clark Kent doesn't. You need the burning building first, then someone comes and saves the day. So I sort of think of it as being reflexive, and the lot worse everything gets, then you forge a solution. It's a bit like in France at the moment. Macron would probably quite like a bit of a bonfire of French bonds that might crack heads together as he tries to get his parliament to work. But anyway, so I suppose, I don't know if that is positive, but the closer you get to the crisis, the closer you get to the solution. That's my summary.
thanks ever so much, Helen. And interestingly, there's a little segue, because I was going to take this opportunity to promote the launch of NISA's quarterly UK and global economic outlooks. We're launching those at midnight next Tuesday. And in the global economic outlook, there's in fact a little box just about France. So, so thank you for teeing me up on that one. You will also find amidst there a lot of stuff on tariffs and the possible effects of the tariffs that have now been announced. At the time we put the first draft of these together, President Trump had said he'd probably do it. Well, now we know that he's definitely done it. So there you'll see some excellent analysis on the possible effects of these tariffs in the outlooks. We also have a couple of pieces already on our website on what we think the tariffs will do. So please can I commend those to all of the audience. Okay, I'd just like to close today's event, though, by thanking most sincerely all of our guests, Helen Thomas, Paul Mortimer-Lee, Sushil Wadhwani, Bill Allen, and in his absence, Jagjit Chadha. I hope everyone has a wonderful rest of the day. Thank you very much.
Thank you.